Hello, everybody, and welcome to the October Analyst Call hosted by the Kaiko research team. We're going to get started right now. So today we have a special edition in light of week 2 of Sam Bankman-Fried's trial, which has kicked off in New York. We're going to be looking at the FTX collapse, really diving into its rise, its spectacular fall, and the ongoing market impact. And so Kaiko, ever since FTX collapsed, we have spent a lot of time analyzing the ongoing market impact and also trying to understand what exactly happened on this day and how this has impacted liquidity. So we have some of our most popular charts over the past year, looking specifically at crypto market liquidity. We'll also have Riyadh towards the end of the call present Kaiko's Q3 crypto asset liquidity ranking. But without further ado, we'll get started. So first, if you are new to this call, a bit about Kaiko. Kaiko is a crypto data provider. We were founded in 2014. Today, we have 4 main businesses. The first is our market data. We offer tick level and aggregated data from more than 100 centralized and decentralized exchanges. We also offer BMR compliant rates and indices. These are for investable products. The third business is our quantitative analytics. We offer proprietary methodologies for value at risk, for implied volatility, and some other quantitative tools. And then the fourth is research. I lead research. My name is Clara, and we're joined here by Desi and Riyadh, our 2 expert research analysts. So some latest Kaiko product updates. If you are interested at the data side of what we do, we just launched Wallet Data, which is a powerful new data type for blockchain transaction analysis, essentially providing deep insights into all transactions for a wallet. We also have robust pair prices. This is a outlier resistant pricing data for all trading pairs, giving you very high quality prices for example, Bitcoin dollar. So if you are unfamiliar with Kaiko research, today we have 5 main offerings. We have 2 weekly newsletters, our data debrief sent on Mondays and our deep dive sent on Thursdays. We have a quarterly report, which we actually just published last week. We have a chart book and then the analyst call, which you are on today. And finally, all research that you see is powered by Kaiko data. Kaiko today has data from more than 100 centralized and decentralized exchanges. This is everything from order book data to derivatives metrics to liquidity pool data to lending and borrowing protocols. We sort of have it all. Okay, so I'm going to now leave the floor to Desi. Desi is going to take a look at FTX's spectacular rise and its impact on crypto trade volume and market share. We're going to switch seats because, again, only one table.
So first, I'm going to take a look at the rise of FTX and the reasons behind its popularity. FTX started off as a derivative platform back in 2019, and it was by 2021 actually very popular, especially with professional traders. So what are the reasons behind this popularity? First, very low fees. To give you an idea, the average maker and taker fees for retail traders was around 0.1%, which compares to 0.5% for Coinbase as of mid-2020. So low fees and high liquidity. The second reason is its very expansive product offering. FTX was actually known for its rapid token listings, for its leveraged derivative products, user interface. And then the third reason, it's aggressive marketing and acquisition strategy. We know that just before, a few months before FTX collapsed, it was actually valued at more than $30 billion. So let's take a look at trade volumes. This chart essentially shows the trade volumes for FTX and its US affiliate, FTX US. We see that volumes were a few millions in the beginning of January 2021, and quickly increased to nearly 100 billion for FTX. FTX US was never a big exchange. Its average trade volumes were around 5 billion, which is not that much. But FTX was comparable in trade volumes to Coinbase, so quite significant. So next, let's look at market share. This is the spot market share for FTX. FTX here includes both FTX and FTX US. Actually, its spot market share was not that big. Relative to other exchanges, it was around 8% of trade volumes, which is again comparable to Coinbase, but really not that high when we compare to Binance. However, it was much more dominant on derivative markets. And this is the next chart, which shows the market share of Bitcoin perpetual futures open interest. And what we essentially see is that FTX, together with Bybit, was the second largest derivative market after Binance, with just before its collapse, 15% of Bitcoin open interest. And as I mentioned, actually, the reason for this is that they had a very innovative derivative offering. And the next chart shows the number of perpetual futures, cumulative number of perpetual future instruments listed on the exchange since 2020. The data is available on our website. It covers all the exchanges, or most of the exchanges under our coverage. And we essentially see that between 2021 and mid-2022, FTX was listing more derivatives, more perpetual futures than Binance, which is pretty significant, taking into account the fact that it was not that big. Just for context, I wanted to show also the spot market. And this is the next chart, which shows spot instruments, again, the cumulative number since 2020 and until the collapse of the exchange, which we essentially see is that the FTX was actually lagging behind in terms of spot instruments. It was lagging behind Coinbase and Binance, which were offering a lot more spot instruments than FTX. However, as I mentioned, they were actually pretty liquid and with pretty narrow spreads, which together with the low fees were attractive to traders. And this is the next chart, which shows the average spread for the most liquid Bitcoin trading pair on 8 exchanges. What we see is that FTX was actually offering at times lower spreads than Coinbase and Kraken, a lot lower than Bitstamp, less liquid exchange, less like Binance US. So pretty competitive spreads overall. Next, let's look at market depth, which is another measure of liquidity. Again, this is the bids and asks within 2% of the mid price for Bitcoin on several exchanges. And what we essentially see is that FTX had a market depth just before its collapse, which was comparable to Coinbase. So liquidity, low fees, and very aggressive product offering were behind the rise of FTX. And now Clara is going to dive into the collapse of the exchange.
Great. Thank you, Desi. So essentially, FTX was, although it was one of the largest exchanges in the world, its market share only ever peaked at around 7%. So Binance still, even today, is the world's largest exchange. What FTX lacked in market share, though, it made up for in marketing and brand. Sometimes it felt like FTX was the world's largest exchange, even if they didn't necessarily have the volumes to show it. Okay, so now we're going to dive into the FTX collapse and the ongoing market impact and just provide a quick refresher on what actually triggered this spectacular inferno. So if you remember back in November, FTX had a cryptocurrency that they called FTT. This is what's known as an exchange token. Exchange tokens have always been quite controversial simply because many think that they don't have much value or utility. It's very murky what many exchange tokens can actually be used for. For example, the FTT token was created by FTX but could only be used within the exchange platform. And even then, its use cases were not very clear. I think some traders were able to get some discounts on trading fees. There was some rewards program that you could earn with FTT, but at the end of the day, it had a massive market cap without much utility. So in early November, I think it was November 2nd, Coindesk, which is one of the largest crypto media companies, published an article essentially showing that Alameda Research, which was the trading firm affiliated with FTX, had a ton of FTT holding as collateral. So it was quite suspicious that Alameda was holding so much FTT simply because FTT was created by its sister company, which was FTX. So why would Alameda need to be holding so much of this FTT on its balance sheet? And it was so much that it was concerning, and it made people question what even is FTT. Why is this trading firm holding so much of it? And so on Twitter, especially, a lot of rumors started to swirl, and that's when people started getting afraid. And they started realizing, is FTT actually supporting the entire FTX crypto empire? At this point, you have the CEO of Alameda, Caroline Ellison. She tweeted that she would buy FTT at the price of $22 for anyone. Essentially, it was Binance at this point threatening to sell a bunch of their FTT based on these rumors. And that essentially created a bank run. After this bank run, everyone started pulling out their assets from FTX, and the price of FTT slid below this key threshold of $22. FTX then halted their withdrawals. There was, for a brief moment, Binance essentially said they were interested in acquiring FTX, but then they backed out and then it was over. So we have this price chart of FTT just to show that it perfectly correlates with the collapse of FTX, all of the price movements with FTT. It really was the trigger for what was essentially this giant scam. And so why are we focused on FTT? FTT today, even though it is essentially a useless cryptocurrency, we still see trade volume for it. FTT has no utility right now. It is not used on FTX. FTX is no longer an active exchange, yet it still has, on average, over the past year, $100 million of weekly trade volume. So crypto markets can often be quite irrational, but I would say this sort of peaks at why anyone would still be trading this. So the next question we had is, where is the FTT token being traded today? And if we look at FTT's market share of volume, we can still see it's actually still listed on more than 10 crypto exchanges. However, a key trend is that they're all offshore, unregulated exchanges. Today, Binance has the largest market share of FTT trade volume. It has around 60% market share. You can see, though, that Huobi in light blue towards the end of the chart has recently claimed a lot of market share for FTT. However, looking at our research, we had actually recently uncovered that a lot of this volume that we're seeing on Huobi is quite suspicious. And in fact, the trend in FTT trade volume closely correlates to the suspicious overall volume that we're seeing from this exchange. So we cannot confirm that this is real volume for the FTT token. So now let's zoom back a bit and try and understand a bit of the ongoing impact from the FTX collapse, this time looking at cryptocurrency liquidity. So when we look at liquidity, you can either consider two things: trade volume, which is just the quantity of transactions, or what we call market depth. Market depth measures the quantity of orders on an order book. So when you have a high value for market depth, this is a sign that the markets are very liquid. So in the aftermath of FTX's collapse, we noticed an interesting trend. That is that liquidity, as measured by market depth, essentially collapsed. And it didn't just collapse on FTX, it collapsed on all global exchanges. So we gave this trend a name. We called it the Alameda Gap in crypto liquidity. This references the trading firm Alameda Research, which shut down as FTX was collapsing. And the Alameda Gap also refers to all of the other market makers that lost a bunch of money and essentially had to pull out of cryptocurrency markets, which left a big gap in liquidity. So the Alameda Gap Here we are seeing this on the chart. We can see that liquidity before the collapse in October was a bit more than $1 billion at 1% depth for all of the top cryptocurrencies across all exchanges in Kaiko's coverage. And then after the collapse, this has more than halved. We're now at just $500 million. So what's really interesting about this trend is that there has been virtually no change in market depth since the FTX collapse. And this was in November, and even over the past 10, almost 11 months, we have seen very little recovery in this liquidity, which suggests that FTX's impact on the market is ongoing. And so here we have a slightly different visualization of this same data here. Here we're actually breaking down the data by asset. So we are dividing up Bitcoin versus ETH versus other top cryptocurrencies. And the first chart includes FTX and FTX US into the calculation for liquidity, whereas the second excludes it. So the reason that we did this is just to figure out if the Alameda Gap is due to FTX collapsing or due to just global liquidity also collapsing. And so essentially both charts show that it's not just FTX that removed liquidity from the market. All other exchanges have also seen a big drop in liquidity. And in fact, for Bitcoin, this drop has been the worst, whereas for ETH and altcoins, it has not been as dramatic. So the next, we wanted to understand what are global patterns in spot volume across all exchanges, both 1 year before the FTX collapse, 1 month after the collapse, and then the average for 2023. So those are what the 3 bars are referring to. So first, we want to look at 1 year before. Average daily spot volume was $18 billion 1 year before the FTX collapse. This was, again, during the peak of the bull market. Whereas 1 month after the collapse, this average daily spot volume had already dropped to just $11 billion. And then in 2023, the average has been just $10 billion. And I know that there have been many other market catalysts for why there have been a big drop in spot volume. For example, we have a lot of regulatory actions happening in the US. We're in sort of an ongoing bear market, but a lot of this can be linked directly to the FTX collapse. The next we wanted to look at is, again, 1% market depth. 1 year before the FTX collapse, it was around $807 million across global exchanges. 1 month after, this was essentially halved to just $435 million. And then the 2023 average market depth has been just $374 million. And I think this is because a lot of market makers were very harmed by the collapse. They lost a lot of money, and same with the collapse of Genesis, which was a big crypto lender that has really impacted a lot of liquidity providers in the crypto industry. Okay, great. And so now I'm going to transfer to Riyadh, who will present Kaiko's Q3 liquidity ranking.
Yeah, thanks, Clara. So I just wanted to present the liquidity ranking, and I'll also tie it in to this discussion of FTX and FTT by specifically focusing on exchange tokens. So if we go to the first slide, we can see the different components that make up this ranking. So in this quarter, we've included 2 different market depths, 0.1% and 1%, just to give a little bit more holistic view of depth. Volume, so just a simple volume measure, excluding any exchanges that we found that have suspicious volumes. Spreads, so this is a median spread, and then exchanges. This is a liquid exchanges measure. So you can see that it shakes out about how you would expect: BTC, ETH, XRP. The first big underperformance is BNB, which I believe is 3rd in market cap right now, but clocks in at 8th in our liquidity ranking. But again, I do want to focus on the exchange tokens, which, if you look all the way to the right, you can see that they perform very poorly across all metrics, and notably are not considered liquid on any of the exchanges they're traded on, according to our methodology. So if we go to the next slide, we can just see an example of sort of what this looks like in practice. Okay, great. Here we have, could we go back? Median spreads. And you can see that, oh wait, I think we went back. There we go. OKB is by far the worst. This is OKX's token. CRO and Leo, these are Crypto.com and Bitfinex's tokens, also perform very poorly. And you can see at the bottom those small orange lines. Those are, where most of the tokens included in this ranking fall. Somewhere in the like 10 to 20 basis points range. And as you can see, OKB is pushing 150 for most of the month. So pretty poor. If we go to the next slide, this is broken down the liquid exchanges ranking, which is essentially just how many exchanges have enough depth based on the token's market cap. And as you can see, OKB, Leo, and CRO have none. So that means even on the exchanges that the tokens, are affiliated with, they're not considered liquid on those exchanges, which I would say is pretty concerning. And then probably the most concerning thing is if we move to the final slide here, is the just underperformance. These tokens have pretty high market caps, and their liquidity does not match that. So you can see OKB underperforms its market cap by about 15 spots, Leo more than 20, CRO about 10. So, I think there was some belief maybe like in the aftermath of FTT that a lot of these exchange tokens would, die out or something like that, or, their market cap would become more reflective of the liquidity, and that actually has not happened. I think their market caps have shrunk, but not in a way that's directly correlated to their liquidity. And I should also mention BNB again here. It's I think it does have a few more use cases than some of the other exchange tokens mentioned, but again, it does underperform a little bit based on how huge its market cap is. So yeah, I think just something to keep an eye on. Again, I'm not claiming that these are in any way, reminiscent of FTT, because there was the whole issue with Alameda there. It is just something to, keep an eye on, potentially concerning, but again, we don't have any indication that there's some sort of, trading scheme going on here. So yeah, happy to move on to questions.
Great, thank you, Riyadh. So we're on to our Q&A session. Feel free to ask the questions directly in the chat. And I saw someone asked for slides. You can email us at research@kaiko.com, and we'd be happy to send you over a copy of these slides at the end of the presentation. Okay, so I see we have one question from Eric. So please explain why you describe Wabi's overall volume as suspicious, not just related to its FTT volume. So this was in reference to an analysis we did a few weeks ago, essentially looking at patterns of trade volume where we compared exchange volume to essentially the norm of what we've been seeing over the past few months to identify if there's any discrepancies from one exchange to the other. And we noticed that sort of across the board, there had been sort of an unusual increase in trade volume on Wabi during a certain time period. It was a very confined time period, and it didn't appear tied to anything that happened on the exchange or anything happening in the markets. So we always flag activity like this as a bit suspicious. Again, it's very hard to prove this just because the data is anonymous and it's not tied to any individuals. So we're not able to be 100% certain. So this is why it just looked a bit suspicious.
In the case of Wabi, I'll also add that if you look at our WorldCoin launch deep dive, we have observed patterns that look, as you would expect wash trading to look. Again, as Claire mentioned, it's anonymous, so we can't say 100% certain, but there's just, unusual clusters of activity that look a lot like wash trading. Combined with, the overall trend, it seems pretty clear.
Okay, we have another question from Georgios. How is liquidity measured in this case? Feel free to clarify which case you're looking at. If this is the crypto asset liquidity ranking, I'll let Riyad take that.
Yeah. It looks like he's typing. But yeah, as mentioned, there's two different market depth measures, volumes, spreads, and the liquid exchanges metric, which again is just does this exchange have enough liquidity relative to that token's market cap? So we assign points to those 5 metrics and score it based on that. So try to make it as holistic as possible, and incorporate a lot of different metrics that traders or holders or projects themselves would be interested in to measure liquidity.
Great. And another question from Eric. Can you all weigh in on Binance's reliance on its BNB token as possible collateral? Are there similarities to FTX and FTT? This is a great question, and I'm sure what a lot of people are having in the aftermath of the FTX collapse. Maybe Riyad, if you have any deeper insights on this, I'll let you take this.
Yeah, I don't. I think a lot of the concern has been speculation, and I think it's fair to speculate. But I don't think we can prove anything definitively using the data at this point. So yeah, again, something to just keep an eye on. But I will say that BNB, as I mentioned before, definitely does have more use cases than FTT. With Binance Smart Chain, like used as a gas token there. So I don't think that they're directly, comparable, but they certainly rhyme a little bit.
Yeah, and I think the biggest issue with FTT was it seemed to be used as collateral by Alameda Research. They used it to get a lot of loans, and they posted FTT as collateral. So it just turned into this, like they were essentially using nothing. Like if we assume FTT was worthless at the time and not tied to any real value or utility, they were getting free loans essentially from both FTX, but I think it was some other lenders as well that they have been getting loans from by posting FTT as collateral. So from what we see, this is not happening with BNB.
I think there's also a question about how the fallout will impact crypto markets moving forward, and if the selling will have a big impact. I don't know. Do you guys have a take on that? I think people are maybe overestimating the selling pressure because of that 100 million limit. I've actually seen that they'll probably undershoot that and instead, try to sell into strength. So it's not just going to be a fire sale. I think that'll put a little bit more weight on upward price movements, but it's not, like a systemic risk. I would think.
Yeah, it's also in their interest to get a good price for all the assets that they sell. They don't want to just liquidate everything because that's going to cause markets to crash. And not only that, everyone's looking at them very closely and scrutinizing how they do these sales. And if it seems like they're being reckless about it, like everyone can see it.
Yep.
All right. Well, that concludes our call, and we look forward to seeing you at the next call. I am going to quickly send the link so that you can register already. This will be on November 14th, so about 5 weeks from now. It still has the same name as the old call, but if you register, it will not be on FTX next time. It will be on a separate topic. So thank you, everybody, and we look forward to seeing you next time.
Thank you.